As of Wednesday, March 18, 2026, the global financial markets are completely locked in a dangerous high-volatility stasis. The algorithms running institutional portfolios are struggling to resolve a severe paradox. A fragile technical recovery in global equities is crashing directly into aggressive macroeconomic headwinds. The active threat is a stagflationary pincer. An exogenous energy shock is colliding with sticky U.S. core inflation, meaning price levels are stubbornly resisting any downward adjustment. Institutional capital is freezing in place. Market makers anticipate the Federal Reserve will enforce a restrictive monetary policy hold to combat localized inflation data. Active managers are taking a defensive posture. They are rapidly rotating out of high-beta growth equities, stocks that exhibit extreme price volatility, and retreating into sovereign commodities. Surviving this high-volatility regime requires mapping the chain reaction. We have to track the exact sequence of events, from a physical supply chain breakdown directly into the resulting institutional asset flows. The catalyst for this market dislocation is physical. Iranian naval drills have created a severe maritime bottleneck in the Strait of Hormuz. This single geographic choke point effectively cuts off 25% of the world's seaborne oil trade. By halting transit, this structural bottleneck immediately forces a $20 to $30 war premium into the valuation of global crude. This chart tracks the resulting price action. Brent crude shows a parabolic 6.90% daily surge, breaking past the psychological $100 barrier to reach $100.12. A sudden geopolitical disruption of this magnitude operates as a pure exogenous supply shock, an external event that standard central bank predictive models are not built to forecast. This disruption creates a pass-through effect. Industrial sectors globally absorb the hit, facing severe imported inflation and elevated global freight costs. The price of steel HRC holding at $1,060 proves the point. The data confirms that industrial input costs remain stubbornly elevated. Compounding the war premium is immediate diplomatic friction. The United States has threatened to delay bilateral summits with Beijing until Chinese authorities assist in securing the oil route. A localized naval standoff has now reset the global baseline for industrial input costs. Inflation will remain sticky as long as the transit routes remain contested. Connecting $100 oil to the persistent 3.1% US CPI data solidifies the stagflationary narrative. CPI, or the Consumer Price Index, tracks the average cost of consumer goods, and the elevated data confirms inflation is entrenched. Persistent inflation completely eliminates the possibility of near-term dovish monetary policy, or rate cuts, from Washington. The Federal Reserve is forced into a hawkish hold. They must keep interest rates restrictive, locked in the 3.50% to 3.75% band. With the immediate rate decision frozen, algorithmic trading models are shifting their entire focus to the summary of economic projections and the 2026 dot plot, the Fed's visual projection mapping each official's forecast for future interest rates. This flowchart illustrates the fiat reaction. The rate expectations trigger a massive safe haven bid, driving the DXY, the US dollar index, up to 99.65. The strong dollar exerts a violent contagion effect on the Japanese yen, pushing the USD to JPY currency pair to 158.9. A valuation of 160.00 is the critical intervention threshold. Breaching it will force direct action from the Japanese government to stabilize their currency. The Bank of Japan is in a policy deadlock. They cannot raise domestic interest rates to defend the yen without crushing a domestic economy that is hypersensitive to the cost of imported oil. Restrictive U.S. monetary policy is actively exporting extreme currency volatility to Asia. This dynamic establishes a dangerous tipping point for global liquidity. Under the pressure of this stagflationary pincer, major equity indices are exhibiting severe technical breakdowns. The S&P 500 is highly vulnerable. Energy-driven input costs are currently projected to severely erode Q1 corporate profit margins. This daily candlestick chart reveals the structural damage on the S&P 500. The index is tracing a head and shoulders breakdown, a classic technical pattern signaling a reversal from bullish to bearish, sitting just below a heavy resistance cluster at 6780. Institutions are hedging this downside risk by paying extreme premiums for put protection, options contracts that gain value when the market falls. This heavy hedging keeps the VIX, Wall Street's primary fear gauge, elevated at 27.29. In Europe, the GAX is hovering at 23,564 in a state of fragile resilience, propped up temporarily by Chinese industrial data. High energy costs operate as an existential earnings killer for the DAX, posing a severe threat to its chemical and heavy engineering constituents. Technically, the DAX is caught in a trap. It is forming a bearish flag, a pattern indicating the continuation of a downward trend, capped tightly by price resistance at 23,800. Japan's Nikkei 225 presents a different trap. The index has reclaimed the 54,000 level, but remains entirely hostage to the USD JPY intervention threat. High beta industrial and tech indices are structurally trapped. They face rising input costs on the bottom and capped liquidity on the top. The Indian stock market has become the ultimate microcosm of this global conflict, locked in an unprecedented institutional tug-of-war. The initial shock triggered a Black Monday sell-off. The Nifty 50 formed a bearish Marubozu candle, a solid, shadowless price bar indicating overwhelming selling pressure from open to close, ending at 24,028. Foreign institutional investors, or FIIs, initiated massive capital flight, aggressively offloading 9,365 crores in equities to flee into the safety of U.S. Treasuries. This chart compares the exit to domestic defense. DIIs absorbed 12,593 crores to maintain the floor. In derivatives, the Nifty 50 churns near 23,580. The options market shows a bearish 0.84 put-call ratio, with max pain pinned at 23,600. Heavy call writing at the 24,000 level, where traders are actively selling call options to create a ceiling, fundamentally caps any near-term bullish breakout. India's current market stability is an artificial floor. Domestic absorption is masking the aggressively bearish undertone of global institutional flow. There is one structural outperformer in this global stagflationary environment, the Saudi Tata Wall, or TASI. The $100-plus Brent crude energy supercycle provides the kingdom with a massive fiscal cushion. This localized oil revenue allows the TASI to completely decouple from the growth scares currently paralyzing Western markets. This split-screen comparison charts the technical divergence. On the left, the TASI holds steady near 11,006. Supporter national portfolio managers are actively using the Gulf Cooperation Council markets as a stagflation hedge. They are prioritizing guaranteed energy revenue over localized war risks. The tactical directive for the current trading session is strict. Active portfolios must execute a defensive pivot. Capital should be rotated directly into defensive PSU energy and pharma sectors. These assets provide a necessary hedge against the dual threat of oil spikes and a rising USD to INR exchange rate. For Indian equities, algorithmic traders must monitor one critical threshold, the Nifty support level at 23,100. A daily close below 23,100 will invalidate all domestic support and trigger a systematic algorithmic liquidation down toward the 22,750 gap fill area. Until naval freedom of navigation is restored and the Federal Reserve signals a pivot, institutional survival demands high cash ratios and ruthless defensive positioning.